The financial landscape, it feels like it's constantly shape-shifting, doesn't it?
Yeah.
You got the established world of traditional finance, TradFi, and then this incredibly dynamic realm of decentralized finance, DeFi.
Yeah, it really does.
And what's really fascinating, I think, is seeing how these two are starting to connect, maybe even converge.
It is a pivotal moment, definitely. And, the linchpin in this convergence, the bridge, really is this concept of real-world assets, RWAs. We've been poring over a ton of material to really dissect what this means for you.
Okay, RWAs.
Yeah.
We hear the term bounced around a lot. In the blockchain context, what's the core idea? What do we need to grasp?
Think of it this way. RWAs on the blockchain are basically digital tokens, but they represent a claim on something valuable that exists outside the crypto ecosystem.
Outside of.
Yeah, it's a tokenized form of ownership,
Yeah.
or maybe the economic rights to a physical asset or even a traditional financial one.
Okay, give me some concrete examples. Like what kind of real-world stuff are we talking about getting this digital wrapper?
Sure, so on the tangible side, you've got things like real estate. Imagine owning like a fraction of an apartment building through a token.
Okay.
Art, maybe fractionalized ownership of a masterpiece. Commodities, think of a digital token representing gold that's actually sitting in a vault somewhere. Even, unique things like classic cars are starting to enter this space.
Wow. Okay. And it's not just physical things, right? You mentioned intangible assets too.
Absolutely. Yeah, the scope is actually surprisingly broad. Intangible RWAs, they include things like government bonds, corporate bonds too, shares in companies, intellectual property like patents or music royalties, and even newer categories, things like carbon credits.
Right, carbon credits. We'll have to get into that. So the fundamental thing to understand here is that the value isn't just generated within the blockchain itself, like with Bitcoin or something.
Exactly.
It's tied to that underlying real-world asset.
Precisely. That's the key differentiator from crypto-native assets. The value originates externally off-chain. And, it's worth noting, KPMG pointed this out, when you hear RWA in this blockchain context, it almost always means these tokenized versions of traditional assets. Just a heads up for listeners, it's not the same as the old TradFi term risk-weighted assets.
Ah, good distinction. Same acronym, totally different meaning.
Totally different worlds, yeah.
Got it. So our mission here in this deep dive is to really dig into RWAs, understand why they matter, the mechanics of this tokenization process everyone talks about, and just explore the incredible range of assets involved.
Exactly. We want to provide you with a clear, insightful understanding of this rapidly evolving area, because it is moving fast.
All right, tokenization, that's the buzzword. Let's break it down. What's the actual transformation happening when an asset gets tokenized?
Okay. So at its core, asset tokenization is about taking the rights associated with an asset, could be the rent from a property, could be dividends from stock, and converting those rights into a digital token on a blockchain. And these tokens, they serve as a verifiable digital proof that you own that right or you're entitled to that benefit.
So it's kind of like creating a digital key almost that unlocks the value of that real world thing.
That's a pretty good analogy, yeah. Think of it like creating a digital twin of the asset on chain, but it's more than just a record. It really harnesses the power of the blockchain technology itself.
Okay, break down those essential blockchain elements then. What makes this work?
Okay, first, as we said, the digital representation. You create that token on chain. Second, blockchain as the bedrock, the foundation. You need platforms like, say, Ethereum, Polygon, Polymesh, Solana, Avalanche.
Right, the big names.
Exactly. They offer the crucial security, the transparency, the immutability that you need to trust these digital representations. Think of Ethereum smart contracts enabling really complex governance for some of these tokenized assets.
So the blockchain gives you that secure, transparent ledger. What else is key?
Third, and this is huge, is the power of smart contracts. These are basically bits of code on the blockchain that run automatically when certain conditions are met.
Self-executing code.
Right. And for RWAs, this could mean anything from automatically distributing rental income to all the token holders every month to enforcing transfer restrictions, like making sure only eligible investors can buy or sell.
That automation, yeah, that sounds incredibly powerful. And the final piece, what's the last core principle?
Fractionalization. This is where tokenization really democratizes access. It's a game changer. By dividing a high-value asset, think a skyscraper or a famous painting, into smaller, more affordable tokenized units, it dramatically lowers the investment barrier. So instead of needing millions to get into commercial real estate, You might be able to participate with, a much, much smaller amount.
So instead of needing to buy the whole painting, you could own like 1/10,000th of it.
Exactly.
That really opens up possibilities for, individual investors like you and me.
Precisely. And the true significance, I think, of tokenization lies in embedding these assets with that programmable logic through the smart contracts and making them potentially interoperable, able to interact seamlessly within a hopefully more efficient global financial system.
Programmable and interoperable. Okay, that sounds like a major shift. How does this actually play out? Like, what's the life cycle? What are the key stages when an asset actually gets tokenized?
Right. It's definitely a multi-stage process. It's not simple. It begins with asset selection, really rigorous due diligence.
Okay, first step.
Yeah. You got to carefully identify the asset, assess its real market value, the demand for it, and thoroughly verify its ownership and legal standing. Like, if you're tokenizing IP, intellectual property, you need to meticulously confirm who owns it via patents, copyrights, the whole deal.
Makes sense. You need to be absolutely sure about what you're turning into a token. Any weakness there could undermine the whole thing.
Exactly. Weakness in that first step, serious repercussions later. So after that comes the absolutely crucial step, legal and regulatory structuring.
The lawyers get involved.
Oh, yeah. Big time. This involves defining exactly what rights the tokens represent. Is it equity? Is it debt? Is it a right to income? And then choosing the right legal framework. Often, for assets like real estate or private equity, you see the use of special purpose vehicles, SPVs.
SPVs, right, like LLCs or trusts.
Exactly. LLCs, trusts, that sort of thing. The SPV legally holds the underlying asset, and the tokens represent an interest in that SPV.
Ah, okay, so it's an indirect ownership structure.
Often, yes. It kind of acts as a buffer, a regulatory shock absorber sometimes. It can shield token holders from some direct complexities, and regulators often feel more comfortable with it. Plus, it can offer benefits like bankruptcy remoteness, separating the asset from the originator's potential issues.
So the token might represent a share in the company that owns the building, rather than a direct slice of the building itself.
In many cases, yes, especially for complex assets. Direct tokenization, like putting the actual deed on-chain, can face more legal and regulatory hurdles currently. But regardless of the structure, strict adherence to securities laws like SEC rules in the US, MiCA in Europe,
Mike, though, right?
plus AML, KYC regulations, tax laws, all of that is absolutely non-negotiable. You also have to figure out if the token itself counts as a security. In the US, you'd look at the Howey test.
The Howey test. Does it involve an investment of money in a common enterprise with an expectation of profits primarily from the efforts of others?
That's the gist of it, yeah. Getting that classification wrong or failing on compliance. Huge risks involved.
Sounds like navigating that legal and regulatory maze is a major part of the whole process. What happens once that's hopefully sorted?
Then you get to the tech part.
Yeah.
Token creation and smart contract development. You choose your blockchain platform, Ethereum, Polygon, whatever fits the need.
Yeah.
You pick the right token standard. ERC20 is common for fungible, identical tokens. ERC721 for unique items, like NFTs. And maybe something like ERC3643, the T or X standard, if you need compliance rules baked right into the token itself.
Built-in compliance. Interesting.
Yeah. Then you develop the smart contracts that govern everything. Rules for issuance, transfers, how benefits like dividends or rent get distributed, maybe even voting rights, the tokenomic supply, pricing rights get defined here too. And critically, you need rigorous security audits of those smart contracts. You have to find vulnerabilities before launch.
Security, yeah, obviously paramount when you're dealing with financial assets, digital or otherwise. What's next after the tech build?
Custody. And it's twofold. Custody of the underlying physical or traditional asset and custody of the digital tokens.
Right. 2 layers.
Exactly. For physical stuff like gold, it means secure storage, maybe regulated vaults, often using specialized trusted custodians. And for things like gold, regular independent proof of reserve audits are vital. You need proof that the gold backing the tokens is actually there.
Proof of reserve, like an auditor checking the vault.
Precisely. Usually by reputable accounting firms. For the digital tokens, investors need secure options too. That could be self-custody wallets like MetaMask or a hardware wallet, or using licensed digital asset custodians. Regulators globally are still figuring out the exact definitions of things like qualified custodians, but bottom line, robust security, physical and digital, is absolutely vital.
Secure storage in the real world, secure wallets in the digital world. Got it. How do these tokens actually get into the hands of investors?
That happens during the primary offering and distribution stage. This could be a security token offering, an STO, which is specifically for tokens deemed securities, or maybe an initial coin offering, an ICO, though those are less common now for RWAs due to regulation. Or it could be a private placement to specific investors.
STOs mainly for regulated assets then.
Generally, yes. And for any regulated offering, you absolutely need mandatory Know Your Customer KYC and anti-money laundering AML checks. Gotta know who your investors are. Once they're verified and the funds come in, the tokens get distributed to their digital wallets or their custodial accounts. Again, strict adherence to all the offering regulations is crucial.
Okay, so the tokens are out there, distributed. What happens next? Do they just sit there?
Hopefully not. Ideally, they enter the phase of secondary market trading and ongoing lifecycle management. For investors to actually get that liquidity benefit we talked about, the tokens need a place to trade. That means listing on licensed RWA exchanges or maybe compliant decentralized exchanges, DAXs, or perhaps alternative trading systems, ATSs.
Places where people can buy and sell them after the initial offering?
Exactly. But the work doesn't stop there. There's ongoing regulatory compliance, financial reporting, tax management stuff, potentially periodic revaluation of the underlying asset, and managing any corporate actions like distributing dividends or handling shareholder votes. Smart contracts can automate a lot of this life cycle management.
Automating dividends sounds nice.
It can be very efficient. You might also have redemption mechanisms built in, allowing token holders to eventually exchange their tokens back for the underlying asset or its cash equivalent, depending on the structure. Having robust secondary markets and diligent lifecycle management is really vital for keeping investor confidence high.
Wow. It sounds like a really intricate, multi-layered process. You need expertise in, I don't know, asset valuation, blockchain tech, securities law, custody. It's a lot.
Absolutely. It really is. And as you can see, each stage has its own set of core principles, critical success factors, and frankly, potential challenges and risks. It truly underscores the multidisciplinary nature of this whole RWA tokenization space.
Okay, so with all this complexity, why bother? What are the really compelling reasons to tokenize these real-world assets? What are the big advantages for you and me, for the average person?
The potential benefits are genuinely transformative, I think. The one everyone talks about first is enhanced liquidity.
Right, making things easier to sell.
Exactly. Assets that were historically hard to buy or sell quickly, think private company shares, big commercial real estate, fine art. They can be converted into tokens that potentially can trade on global marketplaces, 247. And fractionalization is key to enabling that.
Smaller pieces, more buyers and sellers.
That's the idea. But it's important to manage expectations here. Liquidity isn't automatically guaranteed just because something is tokenized. It really depends on market depth, how many active buyers and sellers there are for that specific token. We might see a change in the traditional illiquidity premium, the extra return you expect for holding something hard to sell rather than it vanishing completely.
Okay, fair point. Liquidity potential, not a guarantee. What are the benefits we're looking at?
Well, we've already touched on fractional ownership and the democratization of access. Lowering that minimum investment amount means more people can participate in asset classes that were maybe previously exclusive to the very wealthy. That leads to potentially greater portfolio diversification for more people.
Opening doors, basically.
Yeah. Then you have increased transparency and immutability. Because the ownership records and transactions are on a blockchain, a distributed ledger, it can theoretically reduce fraud, simplify the whole due diligence process when you're buying something, and just generally foster greater trust in the system. Everyone can see the same record.
Transparency and trust, always good things in finance. What about efficiency? Does it make things cheaper or faster?
That's another big driver. Greater efficiency and reduced transaction costs. Automation through smart contracts can cut out a lot of the traditional intermediaries, lawyers, brokers, administrators, potentially. This can lead to faster settlement times. People talk about moving from T+2, trade plus 2 days, maybe even towards T+0, almost instant settlement. And that means lower operational costs overall.
Fewer middlemen, faster processing.
Right. You also get global accessibility in 247 markets. Blockchain doesn't care about borders or time zones. So theoretically, anyone, anywhere could access and trade these assets anytime, leading to potentially deeper, more global markets.
So the market essentially never closes.
Effectively, yeah, for these tokenized assets. And then there's programmability and financial innovation. This is really exciting. Smart contracts allow you to build custom features right into the asset token. You can create highly tailored financial products, develop new kinds of yield strategies, deliver more efficient, even hyper-personalized financial services.
Programmable money? Programmable assets.
Kind of. And the underlying cryptographic security of blockchain provides enhanced security for ownership records, reducing certain types of fraud. Finally, there's the potential for streamlined compliance processes. You can, in theory, embed regulatory rules like KYC/AML checks or investor accreditation requirements directly into the smart contract code.
Automating compliance checks.
Potentially. But as we discussed with the legal structuring, this automated compliance isn't a silver bullet. It doesn't replace the need for proper legal frameworks, oversight, and ongoing monitoring, but it can certainly help streamline things.
Okay, those are some really compelling reasons. Enhanced liquidity, broader access, transparency, efficiency, innovation. It's quite a list. Let's get practical now. What kinds of real-world assets are actually being tokenized right now? Let's start with something tangible, something most people can relate to. Real estate.
Yeah, real estate is a huge one. It's a colossal asset class. Hundreds of trillions globally, but often very illiquid, right? Hard to sell quickly. That makes it a prime candidate for tokenization.
Makes sense.
And the projections are pretty staggering. Deloitte, for instance, suggested tokenized private real estate funds could hit maybe $1 trillion in assets under management within the next decade or so.
$1 trillion. Wow. Okay, legally speaking, though, how does tokenizing property actually work for the average investor? Are they getting a piece of the deed?
Usually, as we touched on with SPVs, it often involves that intermediary structure. A legal entity like an LLC or a trust is set up to actually hold the title to the property.
Yeah, SPV.
And then, instead of tokenizing the deed directly, which can be legally complex, what gets tokenized is the equity, or maybe the debt in that SPV. So as an investor, you're typically buying a token that represents a share or an economic interest in the company that owns the real estate.
Gotcha. So the legal agreements behind the token are absolutely critical. They define what you actually own.
Absolutely critical. Now, we are seeing some interesting progress. Places like Switzerland, Liechtenstein, even Dubai, they're making strides in legally recognizing tokenized titles or facilitating property transfer via blockchain. But in many other places, like large parts of the US, the legal framework is still catching up. So many current real estate tokens represent contractual rights, a right to income, a share of profits, rather than direct legal title to the property itself.
So my token might give me a share of the red checks and maybe the upside if the property value goes up, but I don't necessarily have my name on the land registry, so to speak.
That's the common reality today, yes. But the legal landscape is definitely evolving. We're seeing platforms emerge, like Realty, for example. They tokenize U.S. residential properties, holding each in a separate LLC, and distribute the rental income to token holders, often in stablecoins.
Interesting. Any other examples?
Yeah, there have been higher profile projects like Elevated Returns, tokenizing equity in the Aspen St. Regis Hotel. And you see significant activity in markets like Dubai with major developers like Damac Properties and Mag Group launching tokenized real estate offerings. Citadel in Singapore focuses on commercial properties via SPVs. Harbor did student housing. Propi, Block Square, Maddox, there are quite a few players exploring different models.
So it's definitely moving beyond just experimental projects.
Yeah.
What are the specific hurdles when you're dealing with tokenized real estate? Valuation seems tricky.
Valuation is complex. How do you accurately value a fractional share of a unique property? It requires adapting traditional appraisal methods. Luminalta, for instance, has proposed a two-tier oracle system to try and address this. And custody, as we mentioned, is dual. Securing the physical title, usually with the SPV and traditional custodians, and securing the digital tokens in investor wallets or with digital asset custodians. Cybersecurity for both layers is obviously paramount.
Lots to manage, but the potential upside is clear.
For sure. The potential benefits: increased liquidity, lower investment minimums, potentially faster and cheaper transactions, greater transparency on ownership and performance. These are really powerful drivers for tokenizing real estate.
Okay, from the solid ground of real estate, let's shift gears. Something equally tangible, but different. Commodities, starting with the classic precious metals like gold.
Right. Tokenizing commodities like gold, silver, platinum aims to make them more liquid, more accessible, more transparent. The typical process involves storing the actual physical metal in secure, regulated, and importantly, audited vaults. Often LBMA-accredited vaults for gold.
LBMA.
London Bullion Market Association. It's a key standard. Then a legal structure is set up so the token represents a direct ownership claim on a specific amount of that vaulted metal. Smart contracts handle the issuance. transfer, and potentially redemption of the token, swapping the token back for physical gold, though that often has minimums.
And audits are key here.
Absolutely essential. Regular independent proof of reserve audits conducted by trusted third parties, often major accounting firms, are crucial. They verify that for every token circulating, there's a corresponding amount of physical metal held securely in custody. Transparency builds trust.
We've seen some big players in this space already, right? Paxos Gold, Tether Gold.
Exactly. Paxos Gold, PAXG, is a good example regulated by the New York Department of Financial Services. Each token backed 1.1 by gold in LBMA vaults, subject to audits. Tether Gold, XAUT, holds gold in Swiss vaults. Matrix Doc has XAU linked to Singapore HK vaults. Wisdom Tree launched one. There's T-Cell Elver for silver. Even projects like Timons exploring physically backed diamond tokens, though that adds complexity.
So what's the big appeal of tokenized gold versus, say, a gold ETF?
Potential advantages include maybe enhanced liquidity on 247 crypto markets, true fractional ownership down to very small amounts, the transparency from on-chain records and Porta audits, and potentially lower storage or management costs compared to holding physical bullion directly or even some traditional instruments.
Makes sense. What about other commodities? You mentioned energy, agricultural products.
Yeah, the scope is broader, but the focus often shifts slightly. For things like crude oil, natural gas, or agricultural products like wheat or coffee, tokenization can represent ownership, but often the emphasis is also on streamlining complex supply chains.
How so?
Using blockchain for better traceability, proving the origin and quality of goods, reducing paperwork and costs. Think of Walmart's Food Trust initiative, using blockchain for tracking food provenance. Here, the proof might be less about proof of reserve of a bulk amount and more about proof of process or proof of quality along the supply chain. Integrating with existing standards like GS1 EPCIS for tracking is also important.
So less about trading ownership of a barrel of oil, more about tracking its journey.
In many current use cases, yes. While liquid trading platforms for tokenized crude or corn aren't as mature as for gold, you see blockchain being used for niche financing or improving supply chain efficiency. But there are unique challenges.
Like what?
Securely storing diverse, sometimes bulky or perishable assets is tough. How do you value non-standardized goods accurately? Think different grades of coffee beans. Navigating international regulations across different commodity markets is complex, and integrating with existing, often very intricate supply chain systems takes effort.
Seems like standardization is key for these other commodities to really scale up like gold.
Absolutely. For broader commodity tokenization beyond just gold to really achieve deep liquidity, we need more standardization, defining clear attributes, verifying quality consistently, establishing reliable custody solutions for diverse assets. Industry bodies and integrating existing frameworks with blockchain will be crucial.
Okay, moving from tangible goods to the world of finance itself. Debt instruments. How are bonds and loans being tokenized?
This is a massive area. The global bond market is enormous, over $133 trillion. Tokenization aims to bring parts of this onto the blockchain to streamline issuance, boost liquidity, cut costs, and open it up to more investors. We're seeing activity in traditional corporate and government bonds and also huge growth in tokenized private credit.
Let's start with the traditional bonds. Any real-world examples of companies or governments issuing bonds on a blockchain?
Yeah, quite a few interesting cases. The Société Générale, the French bank, tokenized covered bonds, OFH tokens, and used them as collateral within the MakerDAO DeFi protocol.
Wow, a major bank's bonds used in DeFi.
Exactly. Siemens, the German industrial giant, issued a 60 million digital bond directly on the Polygon network. The European Investment Bank, EIB, has done multiple digital bond offerings on different platforms. The World Bank pioneered this years ago with their Bondi project. Spain's stock exchange operator BME worked with BBVA on a DLT-based bond lifecycle. Governments are experimenting too, Hong Kong, Slovenia.
So what are the benefits they're chasing?
Primarily lower issuance costs by cutting intermediaries, much faster settlement, moving towards that T plus EVER ideal, potentially improved liquidity through fractionalization and reaching a broader investor base, and enhanced transparency of the whole process. Boston Consulting Group, BCG, estimated this market could reach $800 billion by 2030.
Significant potential. What are the roadblocks, especially for traditional bonds?
Regulation is the big one. Bonds are clearly securities in most places, so they fall under strict laws. You have prospectus requirements, rules about investor eligibility, disclosure obligations, market conduct rules. The platforms facilitating this need to be regulated as broker-dealers, exchanges, or ATSs, plus all the usual KYC, SAMLO, and regulatory reporting. And the digital asset regulation landscape itself is still evolving globally, although some jurisdictions like Germany and Switzerland have been proactive.
Okay, so traditional bonds are moving, but cautiously due to regulation. What about this private credit space? You said that's expanding rapidly.
It really is. RWA.xyz, a data site, tracked almost $12 billion in active tokenized private credit loans earlier this year. This involves things like taking loans made to businesses, often SMEs, and tokenizing them.
How does that work?
Typically, loan terms are finalized off-chain, then tokens representing claims on those loan repayments and interest are created on a blockchain. Smart contracts govern the cash flows. SPVs are often used here, too, to pool the loans.
And DeFi protocols are involved.
Heavily involved. Platforms like Goldfinch aim to provide crypto loans backed by these real-world cash flows, using a kind of trust through consensus mechanism instead of crypto collateral. Maple Finance focuses on institutional crypto lending, often backed by receivables. Centrifuge is a major player. Their Tin Lake platform allows businesses to tokenize assets like invoices as NFTs, pool them, and finance them through DeFi, issuing drop and T-time tokens to investors with different risk profiles. They famously partnered with MakerDAO for vaults like Andromeda, Figure, Tradable, PASIT, Credix, TrueFi. There are many protocols exploring this.
What's the attraction for lenders and borrowers here?
For borrowers, the businesses, it can mean access to global capital pools via DeFi, potentially faster and more flexible financing. For investors, the DeFi side, it offers yield supposedly uncorrelated with crypto market volatility, backed by real-world cash flows. It also brings liquidity to traditionally illiquid private loans through tokenization and fractionalization plus transparency.
What are the risks in tokenized private credit?
Several. Regulatory compliance, especially around securities laws, is still a major consideration. Getting traditional institutions comfortable with DeFi protocols is a hurdle. There are technical risks, blockchain scalability, interoperability between platforms, and of course, smart contract security bugs. There's also the risk of overvaluing the underlying loans or collateral and general digital security threats like hacking.
And within this debt space, one area seems to be exploding.
Yeah.
Tokenized U.S. treasuries. Why is that getting so much traction?
Yeah, it's arguably the fastest growing RWA segment right now. Estimates were around $6.5 billion earlier this year, maybe even underestimated. It's driven by a few key factors.
Like what?
Well, platforms like Ondo Finance have gained huge traction with products like OUSG and its recent yield-bearing stablecoin ROUSG. These typically invest in short-term U.S. treasuries or treasury ETFs, or money market funds like BlackRock's own BUIDL fund. Ondo provides exposure for qualified investors, often tokenizing interests in feeder funds. MakerDAO is also a huge player, using tokenized T-bills via RWA vaults, managed by partners like Monetalis Clydesdale and Block Tower Andromeda, using Centrifuge, as primary collateral backing their DAI stablecoin. It's central to their endgame plan.
Even BlackRock itself is in this directly.
Yes, BlackRock launched the BUIDL fund, the BlackRock USD Institutional Digital Liquidity Fund. It's a tokenized money market fund investing in cash, T-bills, and repos issued on the securitized platform. It's aimed at accredited U.S. investors with a high minimum investment, but it signals massive institutional interest. Franklin Templeton has had a tokenized money fund on Stellar for a while, too, leveraging Ondo Tech. Then you have Superstate's USTB, Open Eden's TBL.
So why are treasuries so popular for tokenization?
They offer a relatively stable, predictable yield source directly on the blockchain. This is incredibly attractive in DeFi, especially during volatile crypto markets. They provide high-quality, low-risk collateral for stablecoins like DAI or for other DeFi lending protocols. They create institutional-grade, compliant assets on-chain, which helps bridge the gap between TradFi institutions and the DeFi world. It's seen as a safe, foundational RWA.
And it connects to the stablecoin market.
Absolutely. There's a symbiotic relationship. Tokenized treasuries provide reliable, yield-bearing collateral for stablecoins, making them more robust. Stablecoins, in turn, are often the medium of exchange used to buy and sell these tokenized treasuries. It's a convergence, creating a more mature, integrated DeFi landscape.
Really interesting how these pieces are fitting together.
Yeah.
Okay, let's shift from debt to equity. Owning a piece of a company. How does tokenized equity work?
So this involves creating digital tokens that represent an ownership stake shares in a company. It could be a private company or potentially even a publicly listed one, though private equity is where most of the action is right now.
Why private equity specifically?
Because it's a traditionally very illiquid asset class. If you invest in a private company or a private equity fund, it's usually hard to sell your stake before a major event like an IPO or acquisition. Tokenization holds the promise of creating secondary markets for these private stakes, unlocking liquidity.
How does the process work for private equity?
It usually starts with selecting the asset, maybe shares in a specific startup, or limited partnership interests in a PE fund, or even equity in an infrastructure project. Then comes valuation, which is tricky for private assets. Legal structuring is key, often using SPVs again. Then tokens are issued, typically only to accredited or qualified investors due to securities regulations. Platforms manage ongoing things like distributing any dividends, handling voting rights, and ensuring compliance.
You mentioned valuation is tricky. How does tokenization affect that? Private equity valuation is already complex.
It adds another layer. The underlying private equity is usually valued using standard methods discounted cash flow, DCF, comparing to similar companies, looking at past transactions, often following guidelines like the International Private Equity and Venture Capital Valuation, IPEV, guidelines. But the token's price on a secondary market can diverge from this underlying net asset value, NAV.
Why would the token price be different from the asset value?
Market sentiment, the perceived liquidity of the token itself or lack thereof, platform risks, demand and supply for that specific token, all these can influence the token price. For tokenized funds that offer some liquidity, they might need more frequent NAV calculations than traditional PE funds. Adapting valuation standards like IPEV for the nuances of tokenized equity is still an ongoing development.
So what are the main benefits proponents point to for tokenized private equity?
The big ones are potentially unlocking liquidity for investors stuck in long-term holdings, democratizing access by allowing fractional ownership with smaller investment minimums, enhancing transparency around ownership and potentially fund performance, and streamlining operations like capital calls or distributions using smart contracts. Platforms like InvestaX, IXSwap, and initiatives like General M Partners tokenizing a PE fund on the XRP ledger are exploring this space.
But you mentioned liquidity isn't guaranteed. The illiquidity premium paradox. Can you elaborate?
Yeah, it's this idea that while tokenization enables the possibility of easier trading and thus liquidity, it doesn't create liquidity out of thin air. The actual liquidity depends on having active buyers and sellers in a secondary market for that specific token. If no one wants to buy your tokenized private equity share, it's still illiquid, even if it's technically tradable. So claims of dramatically enhanced liquidity need to be taken with caution. Accurate valuation is also crucial for building that market confidence.
Right. Potential liquidity, not guaranteed liquidity. Makes sense. Okay, moving from owning a piece of a company to owning maybe a piece of an idea, let's talk about tokenized intellectual property, IP.
This is a fascinating area, converting ownership rights, or more commonly, the economic benefits like royalties or licensing fees from IP into digital tokens. Think patents, copyrights like music or books, trademarks, even research data. The potential market here is projected to be huge, maybe $500 billion by 2030, according to some estimates.
How do you even tokenize something intangible like IP?
It starts with verifying the ownership and value of the IP itself, looking at official registrations, licensing agreements, market potential. Then comes the legal structuring and tokenomics, defining precisely what rights the token holder gets. Is it a share of future royalties? A license to use the IP? Equity in a company holding the IP? Then smart contracts are developed to handle issuance, transfer, maybe automated revenue sharing or licensing payments. Finally, the tokens are issued, potentially via STOs, and hopefully traded.
Music royalties seem like a popular use case here.
Definitely one of the most talked about. The idea is artists can tokenize a portion of their future royalty streams from a song or album. Fans or investors can buy these tokens, providing upfront funding for the artist. Smart contracts could then potentially automate the collection and distribution of royalties as they come in, maybe bypassing some traditional intermediaries. Platforms like the early Ujo Music or Mycelia and newer ones like OPUS are exploring this, offering new funding models for creators.
Sounds potentially empowering for artists. But what about the challenges? How do you verify these IP rights are legitimate on a blockchain, and how do you enforce them if someone infringes?
These are the critical challenges, and they're significant. Verifying IP rights on-chain still heavily relies on thorough off-chain due diligence when the token is first created. You need to ensure the underlying IP is valid and the ownership or chain of title is clear. There are efforts like WIPO Proof from the World Intellectual Property Organization to provide digital fingerprints, but it's early days. If the underlying IP claim is flawed, the token's value is compromised.
And enforcement. Does the token help you sue infringers?
Not directly, no. Enforcement of IP rights, stopping someone from illegally using your patented invention or copyrighted song, primarily relies on the traditional legal system in the real world. Owning a token doesn't automatically grant you enhanced legal powers to go after infringers. The legal status of the token, whether it represents actual title or just a contractual claim to income, needs to be crystal clear in the legal agreements.
So disputes could get complicated. On-chain ownership versus off-chain legal reality.
Very complicated. You likely need hybrid dispute resolution mechanisms. We're seeing early legal precedents emerge, like the Hermes versus Rothschild case involving Meta Birkin's NFTs, which touched on trademark rights in the digital realm. But overall, we need much clearer legal frameworks and possibly new types of IP registries that can properly interface with blockchains to bridge this gap between on-chain token ownership and off-chain legal IP rights.
What about those smart contracts distributing royalties? Do they always work smoothly?
They can be effective for revenues generated on-chain. But for traditional off-chain revenues like radio play royalties or physical sales, the smart contract relies on external data feeds, called oracles, or potentially manual input to know how much revenue came in. These are potential points of failure or manipulation, and crucially, a smart contract can't force someone off-chain to pay up if they breach the underlying license agreement. You still need to resort to traditional legal action in those cases, so it's often a hybrid approach.
Hybrid seems to be a recurring theme. Are there platforms actually doing IP tokenization beyond music?
Yes, besides platforms like InvestX, which handle various RWAs, including IP, there are specialized players. Social Oris launched an IP token, SCR1, on IXSwap. Molecule focuses on tokenizing early-stage pharmaceutical IP to fund research. Eternity creates NFTs often linked to celebrity IP. And WIPO itself is exploring how blockchain can be used for broader IP management. It's still an emerging field, but the potential to unlock the value in tangible assets is huge.
Okay, from intangible ideas to tangible culture, let's talk about tokenized art and collectibles.
Right. This involves converting ownership, usually fractional ownership, of high-value cultural assets. Fine art, antiques, rare collectibles like vintage cars or watches into tokens, often called art security tokens or ASTs if they represent an investment contract.
What are the main benefits here? Is it just about owning a tiny piece of a Picasso?
Fractional ownership is a big part of it, yes.
Yeah.
Sygnum Bank in Switzerland famously tokenized a Picasso painting, allowing clients to buy shares. This democratizes access, but it also aims for increased liquidity for these notoriously illiquid assets. Enhanced transparency and provenance tracking is another benefit using the blockchain's immutable ledger, sometimes combined with physical tags like NFC chips, to record an item's history and authenticity. It can also simplify workflows and reduce costs associated with traditional art transactions by automating processes and cutting intermediaries. And for living artists, NFTs offer new ways to monetize digital art directly and potentially earn royalties on secondary sales.
But valuing art is so subjective. How do you handle that, especially if you want to use tokenized art as collateral in DeFi, like for a loan?
Valuation is definitely a major challenge. Unlike commodities or bonds, art and collectibles are unique, and their value is highly subjective, influenced by taste, artist reputation, condition, provenance, and market trends. There aren't standardized valuation models like for stocks. The token price can also be very volatile and may not track the perceived underlying value closely.
So how can DeFi protocols possibly accept this as collateral? How do they price it?
It's tricky. We're seeing the emergence of specialized oracles trying to provide press feeds for NFTs and tokenized art. Some, like Chainlink's NFT floor pricing feeds used by protocols like JPEG, focus on the minimum price for a collection. Others use time-weighted average price, TDEP oracles like BenDAO tried. There are also dedicated NFT valuation platforms like Abacus, Upshot, or NFT Bank using proprietary algorithms, often involving machine learning or appraisal networks.
But these are still approximations, right? Especially for rare items. What are the risks of using art as DeFi collateral?
The risks are significant. Inaccurate pricing from oracles is one. Sudden drops in value, which happen often in volatile art NFT markets, can trigger liquidations. And liquidating unique or niche items quickly without a massive price drop can be very difficult. The market might be thin. That's why DeFi protocols lending against NFTs or tokenized art typically use very conservative loan-to-value LTV ratios, meaning you can only borrow a small percentage of the asset's estimated value.
So LTV ratios are critical. It's definitely not like using stablecoins or Bitcoin as collateral.
Not at all. Art valuation remains subjective, floor prices don't capture the value of rare pieces well, and illiquidity makes liquidation risky. It's an area where caution is needed.
Who are the main players or examples in tokenized art?
Platforms facilitating tokenization often leverage blockchains optimized for securities like Polymesh. Masterworks is a well-known platform offering fractional shares in blue-chip physical art, though their structure might be more traditional equity in an LLC holding the art. Sygnum Bank's Picasso tokenization is a key example. NFT marketplaces like OpenSea are central to the digital art side. There was the conceptual Burn Banksy project, where a physical Banksy was destroyed after being tokenized as an NFT, and major auction houses like Sotheby's and Christie's are deeply involved in the NFT space now.
Okay, shifting from high culture to high stakes for the planet, let's discuss tokenized carbon credits. What's the goal here?
The goal is to use blockchain to improve the transparency, liquidity, accessibility, and overall efficiency of carbon markets. A tokenized carbon credit typically represents the right to emit 1 metric ton of CO2 equivalent, or sometimes represents a verified carbon removal or reduction. It's about bringing environmental assets on-chain. The voluntary carbon market itself is growing rapidly, projected to be worth hundreds of billions, maybe even close to $700 billion by 2025, according to some forecasts, though it started smaller.
How do you tokenize a carbon credit? Where do they come from?
It usually starts with carbon credits that have already been verified and issued by established off-chain registries like Verra, BCS, or Gold Standard. Then a process called bridging occurs. The off-chain credit is often retired or locked in the traditional registry, and a corresponding digital token is minted on a blockchain. Platforms like Toucan Protocol pioneered this, creating fungible tokens, often following the ERC20 standard, that represent pools of these underlying credits, like their BCT-based carbon ton or NCT Nature carbon ton pools.
So you retire the real credit and create a blockchain version.
Essentially, yes. The smart contracts governing these tokens can then facilitate tracking, trading, and eventually burning the token to claim the offset, which should ideally correspond to retiring the environmental benefit permanently. These tokens can then be traded on specialized exchanges or integrated into DeFi protocols.
What are the specific benefits blockchain brings to carbon markets?
Proponents point to enhanced transparency. The immutable ledger can theoretically track the entire life cycle of a credit from issuance to retirement, reducing risks like double counting. Increased liquidity and accessibility tokenization and fractionalization could open the market to more participants and allow for 247 trading. Improved efficiency and reduced costs, smart contracts could automate verification, trading, and retirement processes. And DeFi integration, these tokenized credits can potentially be used as collateral, staked for yield, or incorporated into regenerative finance refi initiatives. Clemente is a prominent example focusing on using DeFi mechanisms to increase the demand and thus the price of tokenized carbon credits.
Sounds promising. But I feel like there have been controversies or challenges in this space.
Absolutely. There are significant challenges. Quality and integrity is a big one. There's been criticism, for instance, directed at some credits bridged by Toucan early on regarding the actual environmental impact or additionality, whether the reduction would have happened anyway, of the underlying projects. Ensuring the quality of the off-chain credit before it's tokenized is paramount. Regulatory uncertainty is another major factor. How these tokens are treated legally and integrated with national or international climate policies is still evolving.
What about things like double counting?
That's a key risk, especially with the bridging process. You need robust mechanisms to ensure that when a credit is tokenized, its environmental claim isn't also used or sold somewhere else off-chain. Market adoption and standardization are needed for the space to mature, and there's complexity and technical barriers, including reliance on Oracle services to link on-chain tokens with off-chain registry data accurately.
So the value and impact really depend heavily on the quality of the original credit and the integrity of the whole process.
Precisely. The blockchain adds transparency to the token's life cycle, but it doesn't inherently guarantee the quality of the underlying environmental claim. Due diligence on the source projects and robust bridging protocols are essential.
Who are the key players besides Toucan and Clemente?
Flow Carbon is another platform focused on bridging and tokenizing credits. Air Carbon Exchange, ACX, operates as a regulated exchange for carbon credits, including tokenized versions. And platforms like Centrifuge are also involved in financing related to environmental assets. It's a dynamic but complex space.
Definitely complex. Okay, we've covered a lot of ground: real estate, commodities, debt, equity, IP, art, carbon credits. Are there any other notable categories of RWAs emerging that we should touch on?
Yes, a couple more are worth mentioning briefly. One is tokenized funds, This involves tokenizing shares or limited partnership LP interests in investment funds themselves, like private equity funds, hedge funds, or even mutual funds.
So instead of tokenizing the underlying asset, you tokenize the share of the fund that holds the assets.
Exactly. The legal structuring often involves the fund itself acting as the SPV or setting up a feeder fund that gets tokenized. Compliance is key, often restricting tokens to qualified investors. The benefits are similar to tokenizing private equity directly. Potentially enhanced liquidity for LPs, simpler administration, capital calls, distributions via smart contracts, and potentially reaching a broader investor base through smaller investment tranches.
Any examples of tokenized funds?
We already mentioned BlackRock's BUIDL and Franklin Templeton's money market funds, which are essentially tokenized shares in funds holding cash equivalents and treasuries. Hamilton Lane and KKR, major private equity firms, have tokenized portions of their funds, often partnering with platforms like Securitize. The EIB's tokenized bonds could also be seen in this light, as they represent claims on a specific issuance vehicle. BCG projects this area could also be huge, maybe $600 billion or more by 2030. Valuation is typically based on the fund's NAV, but again, secondary market token prices can deviate.
Okay, tokenized funds. What else?
Another growing area is tokenized receivables and invoices, particularly in trade finance. This means converting the rights to future cash flows from outstanding invoices or accounts receivable into tradable digital tokens.
How does that help?
It can provide businesses, especially small and medium enterprises, SMEs, with much faster access to working capital by selling these tokenized receivables to investors. It improves cash flow, potentially lowers financing costs compared to traditional factoring, and adds transparency to the process. DeFi protocols like Centrifuge and Goldfinch are active here, connecting businesses needing cash with DeFi liquidity pools seeking yield from these real-world cash flows. Ripple and BCG see significant potential here too. The challenges involve accurate credit risk assessment of the receivables, ensuring legal enforceability, and standardizing data formats.
Faster catch for businesses. Makes sense. Anything else?
One more area, perhaps more nascent, is tokenized infrastructure and energy projects. This involves using tokens to represent ownership stakes or economic rights in large-scale projects like toll roads, bridges, solar farms, or wind power plants.
So fractional ownership of a wind farm.
Potentially, yes. It could enable fractional investment, opening up these long-term, capital-intensive projects to a broader range of investors beyond just large institutions, potentially unlocking new funding sources. The challenges are significant, though. Complex project valuation, very long investment horizons, and navigating the heavy regulatory considerations surrounding critical infrastructure. But it's another example of how tokenization could reshape finance.
It really does sound like the possibilities are almost limitless, touching nearly every type of asset imaginable.
That's the exciting potential of RWAs, isn't it? Applying the transparency, efficiency, and accessibility benefits of blockchain technology to this vast, incredibly diverse range of real-world asset classes.
So, to kind of bring this all together, wrap things up, it seems undeniable that RWAs represent a really significant evolution, maybe even a revolution in finance.
Absolutely. I think they are building a crucial, much-needed bridge between the established, sometimes rigid infrastructure of traditional finance and the dynamic, innovative possibilities of decentralized finance. The potential to unlock immense economic value tied up in illiquid assets is enormous.
And we're seeing this play out, as we've discussed, across just a huge spectrum of assets, from buildings and gold to loans and ideas and even carbon offsets. It's quite remarkable.
Exactly. This diversity is what's driving such a wave of new use cases and financial innovation. Different assets present different challenges and opportunities, pushing the boundaries of what's possible with tokenization.
But it's also clear, listening to all the challenges you've raised, regulation, valuation, security, that there's still some significant hurdles to navigate for this to really hit the mainstream, right?
That's definitely true. We're still in the relatively early stages. The regulatory landscape, as we've stressed, is still developing and often fragmented across different countries. We need greater standardization, technical standards, legal frameworks, valuation methodologies across the industry. Accurately and reliably valuing certain types of unique or illiquid assets in a tokenized form remains a tough nut to crack. And underpinning everything is security, ensuring the safety of both the underlying real-world assets and the digital tokens representing them is absolutely critical for building and maintaining widespread trust and adoption.
So lots of potential, but still work to be done.
Yeah.
As we consider the future of finance and listeners think about everything we've covered, what's one key question you think they should be pondering about RWAs? a final thought to leave them with.
A final thought. Okay, maybe consider this. Looking at that vast landscape of traditionally illiquid assets, all the things that are hard to buy or sell today, which one do you, the listener, believe is most ripe for a fundamental transformation through tokenization? And what could the ripple effects be? What are the far-reaching implications, not just for big banks or institutions, but for individual investors like yourselves and for the broader global economy? This is a space absolutely brimming with potential, and honestly, the journey has only just begun.